Okay, we're live on Clubhouse and YouTube talking to J.O. Medicare expert. Are we ready? Okay, go ahead. Hi, everybody. This is Josh Jelinski, the financial quarterback, live on YouTube. WOR taking your calls on all matters financial. J.O. MBA, CFP, Medicare expert, and certified financial planner, and author of the book we're giving away today to the first 5 of you who schedule and keep your no obligation review. Maximize your Medicare, qualify for benefits, protect your health, and minimize your costs. So, Jay, for our listeners who are not familiar with your work, describe your background.
Well, like you stated, I'm a certified financial planner, and that also means that I am licensed in insurance matters. So for me, insurance is a derivative instrument, much like a put or a call from financial markets that many people have heard of. And for me, retirement planning starts at Medicare, and that was the catalyst to the crazy project of writing Maximize Your Medicare. And that was 10 years ago now, was the first edition. So now we are here, and with all of the changes to healthcare delivery and 60 odd million current Medicare beneficiaries, something that will not stop, for the foreseeable future, 10,000 people a day turning 65, absolutely vital to have it right.
It's open enrollment season for Medicare, and tell us what people should be doing now to prepare.
Well, already at this point in time, if you are a Medicare Advantage or Part D policy owner, the annual election period will begin in a couple of weeks, October 15th. We will know the information actually later today, October 1st, on exactly what is going to be available. The current existing policy owners have received mail called ANOC, Annual Notice of Change, which has detailed the changes to their existing plan from this year to next. That said, there are limitations, meaning there's nothing in there that will inform persons that what they currently have is necessarily going to be best for them next year, 2023.
So what should people do in preparation for Medicare open enrollment? When do they have to make a decision by?
The annual election period runs from October 15th through December 7th. So during this period, I highly encourage people to check. The reason is very simply is that the competitive forces by the sellers is intense, hyper intense even. And as a result, the difference in plans can mean literally over $1,000 a year in benefits or in lower costs or in lower risk. Those for you and I, Josh, are 3 ways of saying the same thing. In which case, very important that people continue, because these evolutions, the changes to these plans will be ongoing, if only for the fact that the sellers are competing at such an intense level. It has benefited the consumers, no question.
Premiums, they'll get $1,000 back in Medicare benefits, or both, I guess.
Well, it depends. But what I really mean is that the package of benefits that someone gets, for example, it can be lower out-of-pocket costs for diagnostic exams. It can be lower out-of-pocket maximums for the entire year from contract to contract. The thing to know about Medicare Advantage specifically is the fact that every single lever, every single dip switch, if you will, is subject to change on an annual basis. And like I said, because of new entrants, because of the intense competition, that this has largely worked in favor of the consumer. So it behooves them. It's a good idea for them to take a look. And because this is that period, which begins on October 15th, to be able to switch plans to get something more for yourself. And that can take all different shapes and sizes depending on where you live and the plans that are available in your area.
So
the same, go ahead, sorry.
So if you're just joining us, we're with J.O. live on YouTube. Clubhouse. Jay is the author of Maximize Your Medicare. Healthcare is the single biggest expense that people have in retirement and, while they're working still. So we'll talk more about that.
Sure.
So Medicare is very confusing. So try to simplify it for us a little bit.
I'm sorry, Josh. What I did, we're gonna have to cut, but we broke up on the question.
Just simplify Medicare for us a little bit.
Sure. So the federal card has two parts on it that is commonly known, which is Part A and Part B. Part A is hospital insurance. It usually has no premium. You qualify as a result of your income tax payments into the federal government. That covers inpatient hospitalization, generally speaking. It has a deductible, which is based off something that is called benefit period, which is not calendar year, but what I like to call and describe as medical event. So if you get hospitalized for 3 days in January, and if you get hospitalized again in July, that's 2 benefit periods, 2 medical events, 2 deductibles. We actually know that in 2023, we have that number now, which has been announced just days ago, early, $1,600 per benefit period. So that's Part A. Attached to that is skilled nursing facility care. For example, if you get a knee replacement surgery and then you need to go to a skilled nursing facility for rehabilitation, that's covered by Part A, as well as blood and hospice. So that's the first line of Part A. And like I said, it is normally without premium when you are become first eligible, which is when you turn 65. The coverage date is the first day of the month that you turn 65 in the overwhelming majority of cases. For Part B, that is called medical. That has a premium. Again, we know that premium for 2023, which is actually lower in 2023 than it was in 2022. It is set for most persons at $164.90. That is due by most persons. There's also an income tax related adjustment called IRMA, which for high income earners may apply to you. You have to pay this premium monthly. There's no getting around this unless it is, for example, given back to you in certain Medicare Advantage plans. That covers what you would expect, meaning doctor's visits, diagnostic exams, durable medical equipment. For this, there is the annual deductible at the number, and the number is $226 next year, which is slightly higher than in 2022. Once you satisfy the deductible, then Medicare will pay 80%. You are responsible for 20% of the doctor's charges or whatever bills that you get according to a Medicare schedule based on where you live. Those are the guts, that is the chassis, if you will, to Medicare. And then separately is prescriptions, which can be purchased as a standalone Part D plan, standalone prescription plan, or it can be embedded inside of a Medicare Advantage plan. So without going into a 3-hour conversation about all the parts, Josh, I think that is the basic setup of original Medicare.
Well, we may go into those parts. So I may pull your arm because people want to know, hey, I'm turning 65. How many people turn 65 every year? You probably know this. I don't know. I mean, 10,000 a day or something.
It is 10,000 a day.
Insane. Is that really true? I've heard that, but
it's 10,000 people a day, and you'll just take us where we want to go, Josh. I'm just a passenger. Sure. It's your ship. You're the captain of the ship.
And we have a live audience on Clubhouse, so if you have a question, type it in the chat box or type it in the YouTube chat. We're talking to J.O. arguably one of the smartest people on Medicare in the country, talking Medicare now, how to protect your money from the dreaded Aunt Irma. We're going to talk financial planning concepts. I know you love that. We can geek out on all types of financial planning concepts. We're talking about the Inflation Reduction Act and more. But we'll take our first break of the hour, folks. If you want his book free, that's called Maximize Your Medicare. Of course, you could buy it. Go to MaximizeYourMedicare.com. Pick it up today on Amazon, wherever books are sold. Or you get it free when you schedule and keep your no-obligation 27-point ultimate financial game plan. So call me now, 888-988-JOSH. That's 888-988-5674. 888-988-JOSH. We'll be back after these messages. And we're back with J.O., author of Maximize Your Medicare, our free book giveaway at 888-988-JOSH if you schedule and keep your 27-point review. And if you have a question, type it in the chat box. If you have questions on all matters Medicare, could be A, B, G, F, whatever. Or maybe you have questions about healthcare expenses or Roths or IRMA timing. A lot of people are taxed. So let's talk about this IRMA problem. Essentially, if you did a good job saving, you're going to get screwed when it comes to Medicare. Because if you have a lot of money in a 401k or IRA and you take withdrawals, those withdrawals, even if you're in a supposedly lower tax bracket, could come back to bite you if those withdrawals exceed a certain amount. So if you have a pension, Social Security, an IRA withdrawals, and IRMA is not for you. Well, she is for you, but she's going to come visit, even though you don't want her to, and you're going to pay upwards of, I've seen what's the highest? Oh, it's about $500 a month, $400 a month, something like that.
For next year, the highest for a person would be $560 a month. And remember that that's just the Part B IRMA. That's also accompanied by a prescription drug plan IRMA, which would then be an additional $76 a month, 76 and change.
So you're looking at over $600 per spouse.
That's right.
And if you're married, that's $1,200 extra a month, just because you were a good little boy and saved in your 401k. So talk a little bit more about IRMA, and then I'll get your thoughts on maybe how listener friends can avoid IRMA. So IRMA just seems unfair. It's like a hidden tax.
There's no doubt about it, Josh, that it is a tax. It walks like a tax. It quacks like a tax. It's a tax. So, and this is what I say when I make presentations, in public.
Sure.
So no question about it. What happens is the IRS and the SSA combined, they look back at your income tax return from 2 years ago. They will then assess an IRMA. You can appeal it. For example, if you retire, you stop working. If you get divorced, for example, there is a specific form. I'm not going to kid you. It's not that fun having to file appeals with the federal government. That said, it can be done. It is based off your modified adjusted gross income. And so you rightly pointed out, then there are a number of different ripple effects for financial planning, retirement planning, and the recognition of earned income. They find out later, in fact, that they have much higher Medicare premiums, and with a little advanced planning and preparation, that may have been reasonably avoided. And that, of course, is the intersection between, which I've always known existed. It just now, because the number is this big, like you rightly pointed out, it's $1,300 a month for a married couple at the highest end. It is a big number, especially when you multiply by 12 months. And now you have a much higher minus sign in cash flows under retirement if you've not managed it correctly.
And the only way to manage it quickly is to do it in your 50s or early 60s. Because the only way I'm aware of it is you have to spend down your IRAs so that your RMDs, when you're 70 and a half or 72 now, don't cause your IRMA to go up, because then it's like a death cross and you can almost never avoid IRMA. So any other tips there on how to avoid IRMA?
Well, certainly the recent changes, right, in terms of extending the date at which you have to pay required minimum distribution, it can delay it to some degree. But like you rightly pointed out, that if you plan and think through it prior to the years that you become Medicare eligible, it will be very helpful in terms of trying to not go into separate brackets of IRMA, which are, and this is a subtle, but your audience probably likely to be the most able to understand what I'm about to say, which is that the IRMA brackets are hard cutoff numbers as opposed to income tax, which change dollar for dollar. And these subtle points, this is how I use a lot of our time for our financial planning clients. I'm sure you get asked this a lot as well, Josh, which is these subtle differences can make a very big difference.
So what's someone to do? So if they're in their 50s, 40s, even early 60s, basically less than 72, you can avoid IRMA. And if you're past 72, you could accelerate the spend down with Roth conversions, cash value insurances, things that do not recognize income against you. But that's a major tax savings that can be effective if you can do an IRMA plan to eliminate IRMA. So folks, if you want to know more about how to eliminate IRMA, call us at 888-988-JOSH. But it's a lot of times, here's another question we've gotten from having you on and others about IRMA. Can somebody appeal it if it's wrong? Because I find that sometimes people, your IRMA counts, from your income when you were 63, is that correct?
That is right. And yes, you can appeal IRMA, your IRMA qualification. And we're not part of the federal government. I've heard, anecdotally that you can have somebody receiving 2, 3, 4 notices of different Part B premiums as a result of recalculations and restatements. So it can be very confusing. Unfortunately, that's something that I would not be able to control, of course, nor you, Josh, because we are not sitting there with the records of the federal government.
Where would they appeal to? Like, is there a website or?
Yes,
department?
you can. I don't actually have it off the top of my head. But yes, you can appeal your IRMA. There are multiple stages by which you can appeal and reappeal for IRMA if you think it's been unfairly assessed. That is correct.
So if you made a lot of income when you're 63 and you lose your job, you don't have any income when you're 64, can you appeal that or not? Because you're 63, your income was higher, so you have to wait a year.
Yes, it can be because you have to wait a year. That is possible. For example, if you were divorced, however, you became unmarried, I've seen the situation where that has been some other handled in a slightly different way. Unfortunately, like I said, the complication is not only are the rules complicated, but the handling of the rules is also, for me, not necessarily consistent on a case-by-case basis.
So yeah, Google how to apply your IRMA, something like that. So let's talk about, we'll get more into Medicare alphabet soup if we have time, A, B, C, D, F, G. We've had you on in that before. Get into maybe IRMA if we have more time. Congress just passed the Inflation Reduction Act. How does this affect Americans and Medicare?
Well, I called the Inflation Reduction Act Part D's big win, to be candid with you. In other words, I don't think that there's any doubt that the largest beneficiaries for me are the persons who are Medicare eligible with respect to Medicare. And it begins right away next year. So it's not today, but of course it does begin right away next year. For example, Vaccines are going to be $0 and be covered by your Part D plan. And it's not only COVID because, that has been well known. But in addition to that, things like shingles, which there are usually 2 shots for $500 for a year. So certainly that is well worth it. And then on it goes, which is that there are other cost reducing measures on a year by year basis. In other words, it keeps getting better. In 2024, for example, there's going to be a limit that once you hit the maximum, that you don't have to continue to pay for your medications. And for me, the punchline is 2025, when you are going to have a hard cap on out-of-pocket expenses for prescription drugs. So this, to me, for planning purposes, for retirement planning purposes, is an enormous win because of the fact that the hard cap is $2,500 in a calendar year. Much, much lower than the approximately $7,000 that it is today. So as a result, this obviously will mean a huge savings to a lot of persons under Medicare. For non-Medicare, if I could just swerve with one point on non-Medicare, is that the APTC, which is an advanced premium tax credit, has been extended for additional 3 years. And, you've been good enough to have me in the past where we've discussed this, that persons in their early 60s, depending on their location and their income, that combination, they can get very large savings against individually purchased health insurance plans. And literally that number can be in the $20,000 a year savings, depending on the level of their income. Again, this is a tax-related matter. This is a tax credit that you realize on an ongoing basis through the year.
Well, I want to talk more about that tax credit when we return, sure. Taking our second break of the hour. Call us right now, 888-988-JOSH, 888-988-5674. And you can buy Jay's book, Maximize Your Medicare, or get it free when you schedule and keep your 27-point ultimate financial game plan by calling us at 888-988-JOSH, 888-988-JOSH, 888-988-JOSH. We'll be back after these messages. And we're back with J.O. of Maximize Your Medicare. It's our featured book of the hour. Many of you have Medicare decisions. Get educated. Call us, 888-988-5674. Get your free book. We talked earlier about a $20,000 savings for those who pay for their medical insurance out of pocket. Break that down. Who does this apply to? Can you be 58, 64, 50? Who does it work out? Who's eligible for this?
It's actually eligible for anyone, literally across the country. It is based on your income that you are going to be taxed on for that year. And so this is actually income. It is not, unfortunately, people think or call this Medicaid related. Medicaid expansion is a commonly known term. It kind of gives you the stigma, the feel as if you need to also have no asset base. Actually, that's not the case here. The advanced premium tax credit is a tax credit for your income. So you can have as many assets as you have in your bank account, for example, if your taxable income is low or reported to be low, then the fact is that you can have substantial reductions to your health insurance premium. There are conditions. You've got to use the state exchange or healthcare.gov, depending on where you live. And you have to be, for example, if you're married, you have to be filing jointly, etc. And these are important details to get right, because you don't want to over or under report what your income will be or plan to be, because as you can hear, at a difference of $20,000 a year, that is notable. And then in addition to that, if you have received too large a credit, then you end up having to pay it back when you file for your file income tax return for the end of that year.
For this, what income do you need to qualify for this?
So that's an excellent question. It's something I left out, which is that it actually does depend on the household size and the amount of household income. So that's why I can't give you a hard and fast number, but it's all the way up to 400% of the federal poverty level as defined next year. And that scale will slide every single year. So as a result, you'll want to check that. And we do have a look, just so you know, Josh, that we are hearing from filings and has been reported by Kaiser Family Foundation and other very highly reputable sources that we're talking about health insurance premiums upwards of 10% next year going into 2023 at the individual level.
Yeah, no wonder why. The government's capping expenses. None of these great and glorious benefits you're talking about, like capping seniors' benefits, prescription drug costs, that comes with a cost. That means health insurance costs more. And Josh, if I might interject
just for a moment, I apologize to you, which is I misspoke about the cap for prescription drug. It's not $2,500. It's even better. It's $2,000 a year is the out-of-pocket maximum in 2025 for persons under Part D. Tremendous savings.
But that's what I mean. I mean, that's just an amazingly expensive benefit for the federal government. So essentially, is it a single or a couple? So
per person.
So if you're a married couple and you spend greater than $5,000 on cancer drugs, the government picks up the tab on all of that expense. Is that what you're telling me?
So you've wandered into most cancer medications, for example, get administered in a medical setting. That is actually covered by Part B. But things like inhalers, creams, eye drops, people who are prescribed these, they know it, that these are very, very expensive on a monthly basis. Inhaler, $100 a month. So now you can easily multiply 2 to 3 inhalers and now times 12 months, you're above $2,000. Sure. And so as a result, you can hear multiple $1,000s per person of savings for persons, and that's coming soon, 2 years away.
So really then the 10% increase isn't reflective of that. That's reflective of other benefits, other costs. So health insurance going to go up 10%. Medicaid expansion for those 400%. What is the poverty level?
So like I said, it is a very, very complicated scale here, Josh, meaning that it not only depends on an individual person, but also the number of people in their household. So for example, a 55-year-old person with a 24-year-old child living at home, that is an extra person. So it gets a very, very complicated with respect to figuring out what the taxable income for the household is.
Basically, it says here $27,750 for a family of 4. If you're a family of 2, let's say a husband, wife, no kids at home, it looks to be 16 grand, so it's essentially 4 times 16.
Right.
So if you make 16,900 something, you're looking at, if you make 67 grand or less, the government could pick up the tab for your health insurance. That's a great benefit. And it doesn't matter.
It's not 100%, it's a sliding scale, meaning that, for example, if you made, in your example, if you made 66,000, then sure, then the APTC would be minimal. But again, I'm sure you'll quickly connect the dots, Josh. So good at it, which is that if you could manage it, if you could plan for it, that instead your 60 years old and you're at 56,000 because you've withdrawn other monies from cash value insurance, or if you have Roth conversions and begin to take distributions from your Roth IRA at 59 and a half, now all of a sudden you can see you can drive down your taxable income and get this second extra benefit, which is lower health insurance premium, which is, like I said, for somebody at 60 years old around the country, the full sticker price can be expected to be $1,000 a month per person.
And this is basically, for a lot of you, you're pushed out of your job. I was just with a dear couple this week. They're planning on retiring in 2 years at 60. They're about 58 years old. And from 60 to 65, they're not going to have active income, but they're worried about, hey, 20, 30 grand a year health insurance premiums. Maybe they take withdrawals from Roths from 60 to 65, which, by the way, is different than conventional planning would tell you, hey, let that Roth grow. But if you're saving 10 grand a year in health insurance, you have to factor that into your overall rate of return. So
you and I are speaking the same language, Josh. This is exactly why, for example, I was invited to speak about this topic in Nashville at a national conference for wealth managers, because of the fact that that is absolutely the same thing as $10,000 of post-tax return on your portfolio.
Exactly.
Money's fungible, right? So as a result, that needs to be thought of, especially when these numbers are so big, and obviously as very, very difficult financial market conditions this year, very different than simply, glossing over the topic and saying, well, my asset base is growing at 20% a year because, the NASDAQ's up 20% a year or something like that. Now, all of a sudden, the winds clearly have shifted.
And even though we're talking Medicaid expansion, poverty level, you could have $5 million in assets and still have this apply to you. So, folks, if you want to see if Medicaid expansion, probably not a proper word,
right? But
if Medicaid expansion applies for you, call us right now, 888-988-JOSH, 888-988-5674, 888-988-JOSH, and you'll get the twofer, maximize your Medicare. Also had listeners of the show, clients of ours, use Jay for Medicare benefits. So you'll get a twofer, consult with him and my team as well if you want that. But you got to call us now, 888-988-JOSH. Fantastic, holistic financial planning that I don't know many even shows in the country that talk about this. This is kind of obscure things, but this is not obscure. Like this is where people live. You can't control what happens in the market, but you can control where you place your money. You can control where you choose to withdraw from so that you can avoid IRMA, so that you could apply for the Medicaid expansion. A lot of my clients, they retire at 55 or 60 or 62, and there's that 3 years where they're on the hook for their health insurance. And then how am I going to do it? 30 grand a year, I'm just going to keep working. And they already have, $5 million or whatever saved for retirement, or $2 million. And this may not be you folks, but whatever it might be, a lot of people can't work as hard as they used to from 60 to 65. Either they get pushed out, or they lose their job, or whatever it might be. This is really where financial planning rubber meets the road. So folks, call us 888-988-JOSH for the free book. Maximize your Medicare, and you get that when you schedule your no obligation review. 888-988-JOSH, 888-988-5674. We'll be back after these messages. And we're back. This is Josh Jelinski, the financial quarterback. So a lot of people who are working for me are in their 60s. Right, Jim?
Correct.
And more people, some of our best employees, Jim.
Correct.
Jim and others are over 60. And these people are vibrant. They're kicking butt. They're working hard. They're working harder than the millennials, the Gen Zers. So I got to take off for my my sister's bridal shower and all these other things. And I'm like, what are you doing? But these people in their 60s, they're working hard. But healthcare is a big expense for them. Talk about people who are still working. We talked about people who aren't working, they can get that Medicaid expansion. What about people who are working and maybe they work for an employer that the health insurance costs more than Medicare? Can they get Medicare? So can Jim get Medicare when he hits 65 and still work for me? I know the answer, but I want to hear from you.
It's an excellent question, Josh. It's actually, there's a full chapter, 2 chapters actually devoted to it in the book. First of all, is nothing stops you from enrolling in all Medicare entirely from at the time you turn 65. The question really is a math of money question. For example, you're going to be foregoing the employer-sponsored plan or employer-sponsored portion, and you're still going to be responsible. There's not a shortcut to comparing the premiums that you will be responsible for. The other thing is that, for example, if you're the employee, Jim in your case, let's say he's married, he stops working. The question is does he have a spouse? How's that person going to get covered? So again, more layers to the onion that need to be considered in combination with each other. I find, generally speaking, that it's these combinations that are tricky, that need to be thought through. The ones that most persons, when they are happy with me, it's because I've thought through those combinations with them and what they are, and then the timing. What cannot be disputed, however, is the fact that if someone is actually in need of very important healthcare services, the quality of the coverage in Medicare, in the overwhelming number of cases, is going to be superior to the fine print of your employer-sponsored plan, irrespective of how well-meaning that employer-sponsored plan might be, irrespective of the fact that the employer is paying for a lot of it. The actual language inside of either Medicare Advantage or Medigap combined with original Medicare is very likely to be better than that in that employer-sponsored plan.
Makes a lot of sense. So generally speaking, Medicare is better, cheaper. Now it's capping prescription drug plans. I know of no small business that can beat Medicare, but we'll see on a cost perspective.
There are
but
a couple
you bring
of
up the points with spouse. If the spouse is not applicable, apply for Medicare. You're going to bring up some other points?
I would say that you're absolutely right in general. Of course, there are always going to be exceptions. For example, you're a lawyer, you're the partner at a law firm in Manhattan. That instead, what would happen is IRMA would kick in, right, at the highest level, right, if you went to individual Medicare. So you can see that the IRMA ripple effect actually does extend to the higher income classes. Because while the coverage is superior and the employer pays, let's say, half, that half can still be notably lower than Medicare because of the fact that the IRMA level is so high. So again, a little bit more nuanced, and I don't want to say that's the general case, but there are always exceptions why you can't take anything that we've said here today as, blanket statements.
No, exactly. And that's why you always want to call us at 888-988-JOSH for a review. We'll help you. That's why you should never take carte blanche information from what you hear on radio, TV, anything.
True.
Don't be cheap. Get an advisor. Many of us will give you a free consult to see if we're a good fit for you and you're a good fit for us. And right now, we have a great giveaway with J.O. We're giving away his book, Maximize Your Medicare. And I know he's made himself personally available to clients of our firm and listeners of the program. So we'll put you in touch with him. Just call us at 888-988-5674. I had one of my clients reach out to you. He had some questions. He loved you. So fantastic. So Jay, Inflation Reduction Act, any other intersection between the Inflation Reduction Act and Medicare? I'm also going to get, what people don't realize about Jay is he's a genius in so many issues.
I wouldn't say that.
He's one of the few guys in the country like me, not in the genius sense, but in the sense that we understand healthcare is profoundly related to financial planning. We understand holistic financial planning. But I've read your research, and you're not a bad, you understand the markets as well. I mean, I get your weekly or bi-weekly newsletter. So it's not that you're just an insurance guy. You know a lot about markets that most investment guys don't know. Because I remember there was one newsletter you did about randomness and things like that. It was excellent. And I want your take on what people should do in light of these turbulent times in the market. But anything else we got to know about new acts or new provisions in Medicare?
The last thing I would say is that I think that it relates to what you said about just hearing blanket statements and thinking it applies. For me, most of the headlines around the Inflation Reduction Act for Medicare were about the fact there's going to be negotiation of drug pricing between the CMS, which is the federal government, and the pharmaceuticals. The reality is there's going to be a limited set. It's not going to take place for years. And the fact is it's going to just be increased in number gradually over time. For me, that's not the big picture. The big picture absolutely is the 2025, just a couple of years away now, $2,000 cap. This will entirely change the cash flow requirements for certain households. And because they are used to $500 a month, from $6,000 to $2,000 in certain households for a person with high prescription costs. Couldn't be bigger.
Oh, and next I want to ask you about the markets. I got one newsletter and it was a genius thing on the markets. So what do we need to do regarding this uncertainty in the market right now?
I think that, so first of all, by background, I came from fixed income, which is bond market, which has to deal with interest rates. And I think that is, this obscure little location, not in Manhattan, of course, but in the vast majority of the United States, interest rates, the cost of borrowing, wildly misunderstood, the ripple effects unknown to most of the population. And of course, people hear about inflation, but that's just part of it. That's what they see when you fill up your tank of gas, try to buy a box of Cheerios. But I don't think that the ripple effects are fully yet known. And I do think that it has provided certain persons, the savers, with the window that they've been waiting for, which is that these products that if people have liked to throw hate mail at, have liked to throw rocks at, and rotten tomatoes at, well, the circle has come back around, meaning that the interest rate level inside the guaranteed interest rates inside of, for example, universal life products or annuities, deferred indexed annuities, when the market was straight up, when the tailwind was directly behind you, of course, you could say that the market's going to keep going higher. And you are right? The Federal Reserve, absolutely, unequivocally behind you. And as a result, the tailwind's so strong that every other product whose main features were stability and protection, those were pushed to the side because the biggest, most important party on the planet had your back. That said, the environment clearly different today, but for persons who have saved, and don't get me wrong, it's still going to continue to be tough. Jay Powell told you this in the newsletter, which is called Jay's Corner, and I'll have the link for your listeners in the YouTube channel. There's a free and a paid version. The the fact of the matter is, Jay Powell has told you. He told you, and he is the most important single person on the planet. And like I've said in that newsletter, I can't name who's in second place. Literally. This person tells you to expect pain, tells you he's not done in increasing interest rates. The flip side is the persons who have saved, there's now access to actual real return, that we've been living under this environment of there is nothing else. But that now is notably different, having all sorts of ramifications and possibly opportunities for those persons who have the luxury of having savings or possibly rethinking their approach, their strategy, their entire retirement plan.
So the headline needs to be this: Tina, there is no alternative, has been replaced by a golden age of fixed accounts. Meaning, folks, I'm with people, they're calling the office, they're going, can I get a treasury at 4%? Dude, we are having so many people sign up for 1 year and 2 year treasuries. But folks, what happens in 3 years when Jay Powell wants to turn that 2 year treasury to zero? You can lock in 4% right now, 4.5% guaranteed for 7 years with no fee in a fixed annuity, with no advisor fees. So that's a beautiful, I would call it a golden age of fixed interest in fixed annuities, fixed interest, indexed annuities, whole life dividends are going up. IUL cash value is going up. There are so many opportunities that people are not aware of because they listen to the talking heads, which are basically idiots. You know, the talking heads, their salvation to you right now is buy an I bond. You know what? All you can do is put 10K in an I bond. That's it. Can't put more than 10K. But you can do a fixed annuity. And I would argue that once they're done with the carnage, the reason why Jay Powell wants to instill carnage is so that they can lower the interest rates, so that they can lower the debt service to the country. So I think this window is temporary. I don't know about you, but I don't think high interest rates are sustainable forever. So they actually need a recession to lower asset price inflation a little bit so CPI number comes down. What say you on that?
Well, I generally speaking, Josh, I don't pretend to have a crystal ball. I mean, what you've described is certainly a path. What I would say is that, this is not when we were children, right, where the United States was the dominant and pretty much only location along with Europe. Now, you have to remember that for me, the important thing is that the things compared to decades ago is 1.7 billion people have moved from fifth world to first world, where a tremendous storage of wealth and savings sits, with another 1.1 billion just sharing a border, and most of the people below the age of 40, and I'm talking about India. So as a result, that's why I'm not here to say with a crystal ball the way the path of inflation or interest rates will go, because of the fact that, number one, a lot of the money sits now no longer in the United States.
Sure. For those of you just joining us on Clubhouse, YouTube, we're with J.O., best-selling author of the best book on Medicare, one of my top 3 on Medicare ever written, Maximize Your Medicare, Qualify for Benefits, Protect Your Health, and Minimize Your Costs. And if you're just joining us and you have a question on Medicare, health expenses, you also won't want to miss next hour. We have Stan Harley doing some technical analysis for our listeners. So Jay, you talked about portfolio strategies and having 4 or 5 separate accounts that could potentially even mimic each other between spouses, that can have ripple effects, and how it has to be modified notably. Talk about that. What are you getting at there?
Well, what I'm getting at, and you actually pointed it out, right, which is the persons from Roth, generally speaking, people think of it as I've converted money to a Roth, and I'm going to just leave it there because later I can pull it out and never be taxed. If I just turn Rubik's Cube slightly, what do I get? What I could possibly get is the return on the treasury note, creating cash income during those short periods that bring you from 63 to 65 until you're Medicare eligible. And since those coupons, since those cash flows are not taxable, having a very good role and preserving the APTC, which is the tax credit to lower your health insurance premium. So you can see in my very simple example, powerful.
For those just joining us, what Jay revealed earlier in the hour was a way that people who, you could have a lot saved for retirement. You could have 2 million, 5 million. We talk about a couple who's 58 retiring, and she's retiring from a large law firm. He's retiring as an executive of an insurance company or whatever it might be. Just fill in the blank. I'm just some mythic couple. From 58 to 65, the biggest problem for a retiree is healthcare costs. And with this APTC, the government will actually subsidize you if you aren't working to pay for your own healthcare costs. And the rule is you got to make typically less than 80 grand a year. So if you have a couple who they're not getting Social Security, they could delay Social Security till 67. They could delay distributions on their IRAs till 67 or 72. But if you have money in a Roth, you could actually withdraw the money from a Roth and you can get the government to subsidize your healthcare costs. I have a ton of clients 55 to 65, and that is a big thing. And I'm sure phones are going to ring off the hook on that. But that's called Medicaid expansion or APTC. Are they basically the same thing?
They are, and like you rightly pointed out, Josh, which is that it's a little unfortunate because of the stigma of the word Medicaid, but the mechanics are actually different.
So Medicaid, I think it's for poor people. It isn't. It's 400% of the poverty line, which is around 16 to 20 grand. So it's somewhere around 66 to 80 grand if you are a married couple in retirement. It really affects people 55 to 65. Also, give a little, and we were talking about what other things regarding Roth conversions, Social Security timing, Secure Act, should our listeners need to know about in conjunction with RMDs?
Well, I think that what you just stated, and maybe intentionally, maybe not intentionally, I'm not sure, which is that these differences are so big that even Social Security timing, now generally the boilerplate garden variety playbook, of course, is to get the delayed retirement credits, right? And extend out or as long as possible.
So essentially,
the flip side is that Social Security is not taxed like other income.
So really, you create an income bridge.
Correct.
I was one of the first advisors in the country that talked about the income bridge back when I was 24, because this was before Larry Kotlikoff wrote Get What's Yours, The Secrets to Maximizing Social Security and the Big Social. There was a guy who was in, gentleman just passed away last week, John P. Smallwood. May God rest his soul and bless his family at these tough times. Amazing man. We sat around the table, I don't know, I was like 23, 24, very young. And we looked at the problem of Social Security and linking Roth distributions from 62 to 70 to create an income bridge. Because with Social Security, if you delay that, you not only get the delayed retirement credit, which is about 8%, you also get the COLAs for inflation, and 85% of your benefits taxed maximally, which means 15% is not taxed. So if you could create, even if you retired early, create an income bridge take withdrawals from other assets so that you get those delayed retirement credits. So very good. And we'll also be able to go for listener questions. If any of our listeners have questions on Medicare, we'd be happy to have you up. You can type your question in the chat box and we'll bring you up. Any other things that our listeners need to know about Medicare, Roth conversions, etc.?
Well, I think we've covered most of it without going down too further down the wormhole here, Josh. I think that it's difficult, as most persons know, when they look at their brokerage statements. That said, it has always been that I've started Maximize Your Medicare 10 years ago as a self-published book before I signed a publishing agreement for it, which was because to minimize your outflows. That this is not only, as a financial planner, I'm trying to maximize the household net worth. That's the sole goal. And, when interest rates are directly supportive of you, as they have been in one direction at a very, very high level, it has been easy to gloss over this point. I think safely, dramatically, as usual, that this is being challenged. And so it's also a very good, if you will, opportunity, a wake-up call for those persons who are thinking, and I find it actually going to be very complicated for persons who are preparing for retirement, who are trying to build their nest egg to get to a point where they can consider retirement. Persons in our generation, Josh, which are adults, but not yet quite ready to retire, but thinking about the future, that what we're doing here, our conversations, you've been so good to have me multiple times talking about different aspects, which is not, and I know all of the attention goes on the numerator, meaning that trying to get biggest amounts of income and earnings and profits on their financial statements. I get all of that. But equally important is to control the expense level, and knowing about Medicare, knowing about health insurance, and these topics that we have talked about, it tries to accomplish that.
No, fantastic. Well, thank you for joining us. And folks, you can get Jay's book, which is Maximize Your Medicare, by going to MaximizeYourMedicare.com or call my office at 888-988-JOSH. And if you or any of our listeners need help picking Medicare, maybe you have a family member who doesn't know whether they pick G or whatever, or D plan, feel free to call us, 888-988-JOSH. Schedule your free 27-point ultimate financial game plan, 888-988-JOSH, 888-988-JOSH. Thanks so much for joining us, Jay.
My privilege as always, Josh. Thank you very much.
Bye. Okay, now we're ending the YouTube and then Clubhouse.